Obviously, there are a lot of questions in the market right now. And I think at the top of everybody's mind is AI, whether or not we are in a bubble. We saw the big decline in the markets today on that very question. And I know, Mary, you recently said in Riyadh, quote, "It's not that the multiples are wrong. They will eventually be right. They may not be right for every company." So what does that mean for the market and the economy if there is some sort of reckoning?
So thank you.
Just to kick it off with like a very easy.
The easiest question to answer. So first of all, thrilled to be here and such a great audience to have the discussion with. It's a great day to try to debate these things. The valuations themselves are fluid, obviously, and we're seeing a little bit of a reckoning today, and we'll have that for many days to come, ups and downs. AI itself is not a bubble. That's a crazy concept. That's like saying our computer's a bubble. Like, we are on the precipice of a major revolution in the way that companies operate, efficiencies are found, and reaching your client in a whole different paradigm. The valuations of certain companies are reflecting what they think, what the markets think are going to be the winners and the losers. And when you look at the data that we follow, so we track about 2,000 different companies around the world, and we siphon all sorts of information with our own use of AI on that. And you ask it how many companies are actually talking about AI usage in either their products or services or gaining efficiencies in what they're doing. And the highest country that has that is actually US, followed by China. But that's double the rate of companies in places like Europe. So if you say to yourself, is AI in a bubble? You have to get very granular on how you're going to answer that, because in the US, we're starting to gain traction, but we're nowhere near the ability to have the stuff fall to the bottom line and have new products and services out there. But we're way far ahead of places like Europe. So you have to calibrate these things about how you're going to use AI around the world in different companies. And you have to think about it not necessarily as how it's going to be a cost saver, but how it's going to be a revenue driver, right? And so there's different ways of thinking about it. Bear Cognition, which is a company run by my husband, is in the AI data analytics space. And they go to companies, and companies are very reticent to think about hiring them. And they say, well, what about all the people that it might disrupt? And their whole theory is that AI is a workforce multiplier, and that you're trying to create heroes, not zeros, is their tagline, because you're trying to create the workforce of the future that's empowered by AI to be able to do things better, faster, cheaper, quicker, and in a way that clients will come to expect, and anyone not using AI will not have a product or a service that will last.
That's interesting. So it's more of a top-line story than a bottom-line story.
It'll be both, but you got to focus on how you're going to make money with it.
I agree with that. When we think about it, we're looking at it from the infrastructure side, because the bubble conversations we have are, what are public equity valuations telling you about the future? And then what is the CapEx and infrastructure spend? Is it sustainable? Will the demand be there? And we have a very large data center development business. And a couple things that I always anchor on is, number one, if you look at the CapEx spend today, it's about $300 billion annualized CapEx spend from the hyperscalers. That's less than 1% of GDP. Every other time that we've been talking about excess CapEx, you're in the 2 to 5% range. So we have a long way to go in terms of the economic investment relative to the size of the economy to be worried that it would overwhelm. Two, if you think about just core compute, let's not even go to AI and agentic AI and just say core cloud computing demand is growing 300 to 400% per year, and the infrastructure is not keeping up. So while AI will ultimately be a transformational change on the data center side as well, the near-term pipeline is literally just meeting the core cloud compute demand, and 95% plus of the data center market supporting that demand is pre-let. So if you look at where all of the absorption is, all of those data centers are getting taken up on long-term leases by the large hyperscalers. So there's a stability of the capital that is different than we've seen before. Less levered, longer duration, built to suit. And so when you start to think about bubble, I always think about a bubble on the infrastructure side as you're outrunning capacity. The biggest constraint also is just surrounding infrastructure. And so if you look at the 300 to 400% increase in compute, the adjacent infrastructure in the form of power, transmission, and everything adjacent is only keeping pace with about 40% growth. So even if the demand wanted to overwhelm the supply, we can't bring the supply on fast enough to meet the near-term demand. So I just feel there's a lot of hyperbole because the numbers are big and it is that revolutionary. But when you think about the CapEx piece, it just doesn't scream bubble.
And I might just add, because of those numbers I just shared with you, if you look at places like, so I gave you the major regions and who's talking about AI and all the company data that we siphon and we look at. If you look at China, in about 69% of the company Q&As, we go to meet a CEO and the CFO and they talk about it 69% of the time in China. In Japan, it's 19%. So just imagine all those numbers he just said have no Japanese companies factored in because they aren't even talking about using it yet to the degree that other countries are, companies inside of other countries. And so there's just so much room to grow here. And I feel like we're just on the precipice of a lot of this stuff. And so we're in this disconnect of like the world is pricing where AI multiples should be. The companies haven't gotten it through the usage. But it's very much like Hemingway said, how do you go bankrupt? It happens like very, very slowly, and then all of a sudden. And I think that's exactly what's going to happen in AI. It's going to happen very, very slowly across all these companies. Everyone's got their pilots of what they're using it for, either revenues or cost savings. And all of a sudden, when agentic becomes a real thing, when you can start to use vendors in a way that you just plug and play inside your company, you're going to see explosive growth on both the revenue and the expense side. And the suppliers of it are going to have to figure out how they make their way through the, the Python problem.
One of the near-term concerns about the debt is whether or not there is enough of a free cash flow to cover it, to service it. You've seen the concerns out there about Oracle, just given the the amount of issuance we've seen lately. Is that something that worries you as we kind of think about before we see that explosive growth? Is there some tumult that we can expect on the debt side?
It doesn't worry me. Obviously, we're a big lender into the space as well, as are you. There's frankly not enough capital in the debt markets today when you look at banks, insurance companies, and private markets to just satisfy the existing pipeline. And again, whenever you see healthy supply-demand tension like that, that's a good thing. You don't have too much debt looking for investment. You don't have too much equity looking for investment. So if there's anything we're seeing, it's that the equity demand is there and the debt demand has not kept pace. To your point about counterparty, I think the world will begin to differentiate between the different counterparties. They're obviously all investment grade, all largely well capitalized, but their underlying business models are different, and the ability to sustain CapEx at that level will have them each project slightly differently as we get through this. So I think as someone who's a large counterparty, you have to think about Oracle differently than you think about Google. When you're setting these up. But I think for the time being, given the capital structures, it's going to be the debt constraint and the power constraint more than anything.
Yeah, more discretionary. Mary, outside of AI, what do you make of the health of the rest of the economy? There's been a bit of a data void right now due to the shutdown. Can you help us fill in the pieces of what you're seeing in terms of the state of the jobs market, the state of the consumer, the stickiness of inflation?
Yes.
What are you seeing
I think you have four things at play here. One, we're in a decreasing rate environment, almost globally, so that is very supportive for markets. We're constantly looking for signs of inflation, and you feel it in the way that you live, but it doesn't show up necessarily in the way that it flows through to the numbers. I think AI will have a great impact on that in taming that. The counteracting force is that you have tariffs that are a big unknown, and those will raise prices in lots of places if not done with delicately. But you also just have a world where we're facing a much greater peace environment than we have in a long period of time, and that actually changes the flow of funds in a pretty dramatic way, and it keeps things Very tame, very exciting. We just came back from Saudi, where, by the way, we celebrated our 90th anniversary of being in the country. And you look at these places that when you start to get peacetime environments, you get very exciting ways to think about making new investments, new things. And so the consumer, we keep looking for the stresses and strains, and you see them pop out in pockets, and we've watched some credits that have had their issues. There's nothing really synchronized about all of those situations. They're very bespoke in nature. That doesn't mean there's not going to be problems. It's just been a while since we've had a regular cycle of going through that, and when people run out of money, then they have to have a reckoning to that. But it's not anything that feels recessionary in nature, and credit in general, when it has times where pricing becomes a little bit more attractive because it looks a little less good, if there's not a recession on the horizon, it's a great buying opportunity, and you should be leaning in and buying, and that's exactly what they do for us. We are a very large investor in Ares, and we're very proud LPs of yours, and we expect you to do that when you see that stuff back up, especially if you don't think there's a recession on the horizon.
1,000%. I would remind people, I think one of the challenges is we haven't had just a good old-fashioned credit cycle in a very long time, and you actually have a generation of investors who have seen the GFC and COVID and have gotten into a mindset that anytime we have a correction, it's catastrophic. I think when you start talking about a credit cycle, there are normal rhythms to the cycle of the business. We have been at this a long time. If you go back and look at the news cycle at the end of 2019 going into COVID, you'll see headlines talking about how late cycle we were. And then we've obviously accelerated out of the pandemic, and the economy, as far as we can tell too, is extremely strong. Corporate balance sheets delevered, consumer delevered. At least in the US economy, the structure of our mortgage market has created a fair amount of wealth and consumer liquidity. And the best we can all do is just focus on the data in our portfolios. And when you look at the earnings of folks like Ares or the earnings of JP Morgan, there's nothing that indicates that we're late cycle. Our portfolio companies on the corporate side are growing their cash flow year over year, 10 to 12%. They're deleveraging. So as someone who's been doing this a long time, you have to assume that we will have a cycle at some point, but there is a persistence to the growth that we're getting. It could be this productivity is flowing through because people have been calling for a recession now for 5 years and it just hasn't come.
Yeah, the risk actually I see is not necessarily, I mean, the companies have to do their own risk management. We help companies to do risk management all the time, whether they're over levered, et cetera. The fund managers have to do risk management. Have they sized everything right in their portfolio? Is any one thing gonna drag them down disproportionately to others? But the group that I worry most about making sure that they do the stress testing are the retail investors who have now started buying these things, and it's become so addictive because it's a very nice yield that's coming out in their portfolio, and there will probably be a period of time you're not going to get that nice yield. There may not be the liquidity you want out of that side of their portfolio, and that's fine if you ride through the cycle and it's not a deep recessionary bankruptcy kind of environment. But it's not fine if you haven't risk managed the same way companies and GPs and other institutional LPs do. And so that's the part of the world we all have to make sure as advisors we are helping each individual person make sure they've done their own risk management of did that thing get too healthy in my portfolio and outsized? And days like today are good days to think about readjusting your portfolio.
No, it's a really good point. And as we think about the retail investor, one of the key topics in our world is how they diversify into alternatives, which has been a big topic of conversation. I know Ares is big into this. JP Morgan does this through third parties as well as your own proprietary products. How should we be thinking about that against this backdrop of risk management? How should investors be, as they start to kind of dip their toes into alts a little bit more, semi-liquid products, how should they be thinking about ways to risk manage that and do due diligence?
Want me to start us off on this?
Absolutely.
So this is an area where we partner at an extraordinary level. I'm a happy client for many, many decades, and obviously we sell a lot of our semi-liquid product through the JP Morgan channel. I think whenever you talk about retail access to any investment product, I think Mary's point is spot on. You have to focus on fiduciary duty, and you have to make sure that they understand what they're buying. Now, I also believe that sometimes we don't give the everyday investor enough credit for just how smart they are. I've had a situation where I walk around with an Aries logoed sweatshirt, and someone stops me on the street and says, "I listened to your earnings call. Don't cut that dividend. My retirement is supported by it."
Wow.
And you meet those people and you say, well, that doesn't sound like someone who's being sold something that they don't understand. As a capital markets practitioner, I just think any time we can increase access to the individual investor to investment product that will help them through their wealth creation and retirement is a good thing. And it's finally here where the purview of the institutional investor, private equity, venture capital, there's no reason why the retail investor should not have access to institutional quality product as long as it's structured the right way and they're well advised. So a lot of what we partner on is not just the product, but the education of the advisors, the education of the end client, an understanding of the risk. But when you see what alternatives can do mixed in with a traditional 60-40 portfolio, it's a wonderful thing.
Absolutely.
And you're going to just see a continued increase in retail buying of alts because it delivers a better investment outcome in most portfolio constructions.
And that's exactly why the current administration is changing the rules on these things so that you can think about having them in 401k accounts, that you can think about them in the Invest America accounts that will come for the children's future so that they can participate in 99% of the companies out there in the United States of America that are not public. And so why should it be that just institutions get to invest in the things that are not public? And when you're not public, you're not paying a public markets premium, and so there's great value to be found. How do we give that access while properly risk managing it? And so there just should be no such thing as a public markets only portfolio for almost anyone in the world if you can risk management. It should be a public to private continuum. That's how you should think about it. And how you invest that money is just right-sizing the bite size of it, risk managing it, and making sure that everybody has access to these companies. It's just a fabulous opportunity. And it exists on the credit side, and it exists on the equity side, and everything in between.
Yeah.
I think the unlock, sorry, Leslie, which
okay.
is when you go through cycles, and this is not meant to sound paternalistic when I just said that we need to trust the investors more, but what the semi-liquid structures actually do is it allows you to own these assets through a cycle to capture all of the value creation. And ironically, when the market is going through volatility or a downturn, there is no liquidity at the price that you want it. And I think that institutional investors figured that out a long time ago. The retail investor has been trained for generations. Don't lever yourself. Yes. And be liquid, because when things get bad, you need to be able to sell. And inevitably, they go sell the things that they can, not the things that they should.
Exactly.
And I think what we're now seeing, and I think it's why we're seeing the market smoothing, the ownership of these assets, you're almost structuring out the bad behavior because people are doing a better job understanding the liquidity and how much they can give up and get paid for it.
And the sophistication of evergreen funds, interval funds, things that can last through time. We were just talking about some assets that we share and own. And you think to yourself, why should I have to sell that every 5 to 7 years to somebody else to put it in their portfolio if there's an end date to my private portfolio and the thing isn't going public, so it's not going in the public markets, but I want to own it forever and it'll have an appreciation, and I don't want to necessarily have to deal with a mark to market at a particular time that the fund has a maturity date. So all of that leads to more of this stuff being put in portfolios. When done with the right bite size, makes a terrific opportunity for the rest of America and everybody else around the world, but you know that those are the opportunities you can afford.
Yeah, Warren Buffett's been doing it for decades.
Yes, he has.
And I was actually going to follow up and ask you about the liquidity issues, but you answered my question anyway. So we'll move on. Mary, it was a month ago today that JP Morgan announced its Security and Resiliency Initiative that's aimed at financing and investing in companies from critical minerals, pharmaceutical precursors, defense, battery storage, AI, cybersecurity, quantum. How is the initiative going so far?
JP Morgan, we spend a lot of time helping companies all around the world and many of them based obviously here in our home country, the United States of America. And you look and you turn around and you say to yourself, how did we get ourselves in this spot where we don't make the critical minerals necessary to function, that we don't make the parts for submarines to keep our country safe, that we don't make the rocket parts that will protect the things that we need to do in space, and that we have allowed that to not just be made in allied countries around the world, but in other countries around the world where then we don't control our own destiny. And so we said $1.5 trillion will be muscled by JP Morgan into these markets to make sure that we focus on security and resiliency in this country and in our allied nations. And we will put $10 billion worth of our shareholders' capital directly into the equity so that they can also participate in this. And we have got to get our act together. And then you see other countries like Germany that have now the largest fiscal spending since 1989, and they're doing the same thing. And it's like, how could all of us have gotten ourselves in this spot? Mm-hmm. And so we've all got to focus on this, and we've got to focus on what's right, not just for today's little investor for the quarterly earnings, but what's right for the entire continuum of the free world that we live in.
What has been the response? Have you gotten inbound? I mean, were you surprised?
Inbounds, we count them daily. 380 inbounds. We average about 1 inbound of a company in the U.S. per half hour over the past month. 1 per every half hour of the most exciting companies that need capital, they need credit, they need equity investments, they need a pipes transaction. And our teams are getting geared up to be able to make all of these investments to do the right thing and really make a difference, not just in the companies, but obviously for the shareholders of JP Morgan.
And you're nodding, Mike. It sounds like this.
No, it's super.
I'm
I'm excited. That's transformation. The one I don't want to. I'm all in on what you guys are doing. I think the only challenge that we're going to have is it will be inflationary as we reshore critical manufacturing. And so, in this world where we're trying to get the inflation right, that's just something to keep an eye on, because it is not going to be cheap from an inflation standpoint. And it's going to take some time, and how we navigate that transition.
Exactly, and hopefully the 4 factors I talked about as the backdrop, falling rates and AI hopefully taming inflation, really help this converge at the same time. And that's why I think we could be on the precipice of some really fabulous things happening.
Someone has a question? Or two? Oh, there.
Leslie, it was just a reminder that people can submit questions using the Slido app. You can click the QR codes and go on. So hopefully some questions will come in the next few minutes. Or you can raise your hand. There we go. You can do it the old-fashioned way.
I just typed in a question, but this is more sensible. NFTs. You're talking about the private markets, private companies' potential. Can an NFT approach and a trading platform be created in order to participate in that market, because they're not public companies? So in some way or another, you have to create a method to participate in the growth of those private companies. It could be companies that want to be sold, let's say hypothetically, by a private equity firm, mm-hmm. and private individuals can participate by getting an NFT investment in that company.
Yep. So they're
participating in growth, for instance.
Mm-hmm.
This access and the innovation around it is not new. So if you think about what exists today, there are REITs that allow investors on a daily basis with daily liquidity to buy private real estate. You have BDCs, which allow private investors daily liquidity to buy private credit. You have MLPs, which allow you to, so there are structures that have grown and innovated over time that are getting daily liquidity in private market exposure. And now what we're talking about is the next phase, which is how do I own it without daily liquidity, but in a way that is efficient, cost-effective, and gives me the outcome I want. So tokenization of private assets is here now. That is happening. It will create more access and more efficiency. So the simple answer to your question is yes, we're all working on it. The product already exists. It doesn't necessarily mean that there's a new structural wrapper, but the access point is now engaged with tokens.
Yeah. Well, thank you both so much. Mike and Mary, we covered a lot of ground. Really appreciate your time on this important market day, sharing your up-to-date thoughts on everything.
Thank you.
Thank you, everybody.